Yo guys, welcome back to Stock Talk Insider. Today I will be talking about the Honest Company. So, the Honest Company next earnings could be the most important in years. Margins are up, cash flow is improving, but questions about brand sentiment and product reviews still linger. So today let's break down exactly what to expect, what to watch, and what could finally spark a real breakout. So, quick recap is that what Honest actually is. So what does Honest actually do? Honest Company isn't just Jessica Alba's old passion project, it's a growing consumer wellness brand built around clean, safe, and sustainable products. They'll sell everything from diapers and wipes to skincare and household goods, both online and through big retail names like Target and Walmart. In the past year, they focused on profitability and margin expansion instead of just chasing sales. That's key, because it means the business is maturing. What analysts actually expect this quarter is for this upcoming earnings report, analysts expect a revenue of around 93 to 95 million, roughly flat year over year, but with better margins, of course, and EPS standing between 0 and 2 cents. Basically, break even but positive year over year. Gross margins expect around expected around 41 to 42%, which could be an improvement from 39% a year ago. The focus isn't on top line growth right now, it's all about profitability, consistency, and of course that's having to do with the margins. The three financial metrics that matter the most, and you have to take the most of in account with this earnings, is that the gross margin trend, if it pushes above 42%, that's a clear sign operations are scaling efficiently and they are literally doing a very good job. Free cash flow, they've been cash flow positive for multiple quarters now. If that continues, the market starts seeing this as a stable business, not a turnaround bet. Of course, still not the big revenue growth, but again, it's guided up to 6%. Still not as much as it did last year, I think. Inventory and retail velocity. You want to see evidence that inventory isn't piling up and that products sell through at retailers like Target is also improving. The product reviews, which was something I wanted to talk about. Earlier this year, Honest saw a dip in customer sentiment online, mainly tied to a few product reformulations and packaging changes. Some long-time customers complained that certain baby care and skincare products felt different, not necessarily worse, but inconsistent. That short-term wave of negative reviews temporarily hurt brand momentum, especially on Amazon and other retailers, where reviews directly impact conversion rates, of course. But here's what's actually really important. So Honest quickly addressed feedback publicly, reformulated some SKUs back to their original specs, strengthened product testing and consumer response programs, and they did that with several products, improving the products and bringing it back on the market with improvements. Over the last quarter, average review ratings have improved again, moving back toward 4.5 stars, averages across major SKUs. So yes, the review cycle caused a slowdown in sentiment, but has seen some positive feedback again. It is stabilizing, and the recovery in brand trust could act as a hidden upside catalyst over the next 2 to 3 quarters. Why this earnings matters the most, in my opinion? Well, this report is about proving consistency. That's a very big key thing. That the margin expansion, free cash flow, and brand rebuilding are flukes. If Honest posts another profitable quarter over an even slightly positive EPS, it shows they're ready to scale without burning cash. Combine that with improving retail traction and better brand sentiment, and Wall Street will start re-rating the stock, because at a market cap around 400 million, even modest growth and a stable margin profile can justify a double or triple from here. The valuation setup is as follows, so let's talk about the valuation. At around $4 per share, now even $3.60. Honest trades near 1 times forward sales, extremely low for a branded consumer company with 40% margins, 40+% margins actually. If a company hits 18 cents of EPS by 2027 and sustains 10 to 12% margins by 2030, a fair multiple of 30 times EPS gets you back to $5 and $6 in the short term, and potentially on the long term $10 to $15. And as the turnaround fully matures, the market just wants proof that margins will hold. The final take is that the bottom line is this quarter isn't about huge growth numbers, and it probably will not be in the next 1 to 2, maybe 3 quarters. It's about trust. If Honest continues showing improving margins, clean inventory, and stabilizing brand perception, and if Honest continues, and then this earnings call could quietly mark the start of a multi-year rating story. If not flashy, it's not hype, and sometimes it is the best 3x and 4x returns, but yeah, it comes from this kind of steady turnaround, and I believe we still need to see more maturing, more stabilizing in the back of the business, and just improve the margins, improve net income, and then revenue growth can be one of the more bigger catalysts that is improving, and eventually we'll have higher prices, of course. I do have a price prediction of $21, and I will implement that in the next video in how I look on that. I think I did that already in the last video, but of course I want to go more in detail into why I think that is my price prediction by 2030. Well, I'll give you guys all of that info in the next video, and for now this was a new video of Honest. See you guys later.